Now, sort of having laid the foundation for what we might expect for price efficiency, what some predictable patterns that seem to provide some evidence against market efficiency might be, how do financial professionals, sort of the people who are perhaps best positioned to take advantage of any inefficiencies because that's their job, how do they actually navigate this market environment, and how does their activity sort of give us a hint of whether the market actually is or isn't efficient? Well, obviously, if strong form efficiency obtains and the market is completely efficient, then nobody should be able to get abnormal returns. Now, does that mean that there is no room for finance professionals? No, of course not. You still will want to construct optimally diversified portfolios. You won't expect alpha, but you still can reduce idiosyncratic risk, right? You will still want security analysis insofar as maybe you want to know just how risky a firm is. In other words, there's still things to do, but stock picking or trying to beat the market wouldn't be one of them. But, of course, what we know about the Grossman-Stiglitz paradox, that suggests that there is enough inefficiency such that there's actually enough room for financial analysis, people who will try to beat the market, for some of them, at least to earn abnormal returns to compensate them for doing so, simply because without that, information just wouldn't be gathered and prices wouldn't be efficient. So let's actually look at how investment professionals and other finance professionals have done in the historical track record for the US. There's a famous study by Malkiel that looks at the CAPM alphas of equity mutual funds. And what this shows is perhaps not very encouraging. So if you look at where this distribution of alphas falls, and remember, alphas are the abnormal return relative to, in this case, just a single factor CAPM model, you can sort of see that the mean of this distribution is probably a little bit to the left of 0. It's generally bell-shaped, but definitely if you sort of know the distribution of standard deviations in a normal distribution, and this can be conjectured to be vaguely normal, it might fall somewhere around here, and this mean would be well within one standard deviation of 0. In other words, statistically indistinguishable from 0. So no abnormal returns. This is, of course, the average fund. This is, of course, just with respect to the CAPM. But this doesn't seem encouraging in the sense that in this data, the average fund does not produce abnormal returns. Now, we don't really know if these mutual funds are all active necessarily. For example, a passive mutual fund, you wouldn't really expect an alpha, and this is, of course, before the era of ETFs. But if one were confronted with this evidence now, well, this would be a strong reason to then not invest in a mutual fund and just put your money in an ETF, because whoever is managing the mutual fund is clearly not adding any value with respect to the CAPM, at least. And indeed, this becomes a little bit worse if you consider a common bias in performance analysis, which is survivorship. So the data here is for funds that have had 10 years of continuous record, which means that if your fund, let's say, was active for only 3 years and then was closed, it wouldn't appear here. And it doesn't take a huge leap of logic to come to the conclusion that, well, what causes a fund to be closed? It's probably not because it performed too well and the client said, you're making me too much money, I'm going to go elsewhere. The funds that get closed are the ones that perform even worse than average. So in other words, by including the funds that have only been around for 10 years, this study is implicitly filtering out all the ones that have performed even worse than that. So if we were to correct the study by putting in the funds that have been around for less than that have closed even earlier, the average performance would actually be then negative. And this sort of leads to the conclusion of the importance of survivorship bias when trying to assess performance of investment professionals. The importance of sort of looking at the graveyard of the funds that actually haven't survived to this day, because usually those are the ones that will have the really bad performance. And this is important when looking at the performance of, let's say, a hedge fund manager. How have their other funds performed? Mutual fund manager. Really, when considering the track record of anybody, any investment professional, taking into account survivorship bias is really important. So now if we look at the performance of several subsamples, taking into account this idea of survivorship bias and also looking at the effects of fees, here is what we observe. First of all, if you were to put your money in the S&P, the annual return over the decade between 82 and 91 would be about, on average, 17.5%. That's pretty tremendous. Now, if you were to look at just the mutual funds that survived this entire period, remember this leaves out the ones that would have failed early, and that really then overstates their performance because the ones that failed early probably did far worse. And it doesn't really help guide you as an investor because it's fine to filter them out ex post, but ex ante, in other words, before failure, you don't actually necessarily know which funds will fail and which will succeed. So if you put your money in a mutual fund, you might not actually know whether it's one that will last the full 10 years or not. So you might be curious about the effects of survivorship. But the ones that did survive still underperform the S&P, earning only 17.09%. Now, if we do correct for survivorship bias, so we look at all funds, including the ones that failed early, we do see that the performance drops by about 39 basis points relative to just the survivor funds. But this is still gross of fees, so we don't include the effects of the fees that management charges to run these funds. And for that, we have to go to this column, which does include early failure funds and the effect of fees, because of course, remember, the fees that a mutual fund manager charges come out of the fund's earnings, therefore lowering the returns to the investor. We see those are almost lower than the S&P by about 2%, by almost 2%. So essentially, this is a pretty strong critique of portfolio managers as financial professionals, simply in the sense that they don't seem to justify their fees, they don't beat the market. And that, of course, is another way of saying that they don't provide alpha, this idea of abnormal performance relative to risk. This is something that's generally been persistent. The average fund does not outperform the market. There's some evidence that there actually is sort of a persistence in performance. However, there's some funds that are persistently good. There are some funds that are persistently bad. But unfortunately, but perhaps unsurprisingly, bad persistence is much more likely than good persistence. In other words, it's much easier to be consistently bad than it is to be consistently good. but that's sort of what is to be expected for any field that requires skill. In other words, if returns were completely random, then perhaps you shouldn't expect any persistence one way or the other. But if returns are dependent on manager skill, then an unskilled manager will be persistently underperforming, and a skilled manager may be outperforming some of the time, but their performance may still be reduced depending on, well, first of all, how hard they work, but also how efficient the market actually is at any given time. And furthermore, most of the outperformance can then be explained by multi-factor models, because even if we sort of look at alpha relative to a CAPM, we can always reduce that alpha by adding in more factors. And then most importantly even than that, even if you have an alpha that survives whatever exotic factor model you throw at it, it still may disappear once you also take into account management fees. That said, of course, the investor sort of lore is, let's not say full, but has many different examples of managers that do persistently outperform. Warren Buffett, Renaissance Technologies. There's clear examples of managers that actually do post persistently positive returns, but perhaps these are simply rare. And even then, there's a useful paper that I'll put in the description by Burke and Green that shows a negative relationship between flows. In other words, the amount of money a skilled manager is given to manage and their performance, where the idea is that even if you actually do have a lot of skill as a manager, if you do exhibit persistent performance, that'll become known to investors. They will flood you with capital. And ironically, that will actually then deteriorate your performance, simply because strategies don't necessarily scale linearly. If you put 100 million in a stock, you may actually move its price a lot more than if you put only 1 million in it. And that will mean that whatever abnormal performance you would have made with 1 million is going to get pretty much eroded by people trading against you when you make a big enough trade, when you're trying to repeat the process with a much larger amount of capital. So some active funds will outperform the market, but almost all will still underperform these sorts of mechanical strategies that make up either passive investments or the risk factors in APT models that sort of mimic these strategies. Things like small minus big firms, value minus growth, high momentum minus low momentum, and so on. So with that fairly strong academic evidence, what have investors actually done with it? Well, if you actually look at sort of trends in terms of flows over time, where flows that are above zero are inflows and flows that are below zero are outflows, we can actually see that there has been an outflow from active funds, particularly steep over the 2011 to 2012 period, and a pretty consistent inflow into, first of all, index mutual funds, but even more so into lower cost index ETFs, which is very consistent with this type of research. In other words, if mutual fund managers who try to manage an active strategy seem to underperform the market, you should want to invest in the market. You shouldn't want to give your money to these managers who will charge you fees for lower performance. At the same time, even if you want to put your money into a passive indexing strategy, you will probably choose to do it with an ETF rather than a mutual fund, simply because those fees, which detract from your actual realized performance, are lower in an ETF than in a mutual fund. So it seems like investors are actually being quite rational about incorporating this set of results. And this actually extends beyond just active mutual fund management to more recent work in the value of private equity management. These issues are seemingly similar. Finance professionals may not be earning as much in active management as an investor may like. So, do analysts add value? Well, analysts, of course, don't manage portfolios actively, but what they do is they provide recommendations about stocks. So in some senses, their role is similar to a stock-picking active manager. They will make predictions about what stocks will do well and which will do badly, but they won't actually manage a portfolio. That said, can we actually trade based on these recommendations? Well, another academic study looked into this by Barber, Lahavi, McNichols, and Truman, and what they found is that before transaction costs, stocks that have a lot of positive analyst sentiment, ones that analysts really like, do outperform a passive market strategy, and they do produce positive alphas relative to expected returns. But, of course, the strategy requires a lot of portfolio rebalancing because analyst recommendations will change. Some stocks will fall out of favor, others will become the new sort of analyst darlings, and when you take transaction costs into account, then in their study the abnormal profits will disappear. So in other words, the stocks that sort of before trading costs are best liked by analysts do outperform the ones that are least liked by analysts, and the ones that are best liked actually outperform the market. And if you were to, for example, create a long-short strategy where you would buy the ones that are best liked and short the ones that are least liked, you could potentially beat the market, but then it really is a matter of what your trading costs are. In a later study, the same analysts actually looked at what happened in a bubble period. And there actually you found a reversion. The stocks that were least liked actually outperformed. The stocks that were most liked underperformed. So, well, I guess just like a lot of other people at the time, analysts seemed to be caught up in the euphoria of the bubble period and vastly sort of outestimated the performance of whatever stocks they thought were going to do well. So overall, analyst recommendations are not necessarily a better signal than portfolio manager recommendations, which is perhaps not surprising. But remember that unlike an active portfolio manager, an analyst actually does have a lot of other important functions in terms of forecasting fundamentals, looking at trends, other useful information. For example, in the recent COVID pandemic, there was a big focus on firm cash holdings and sort of burn rate scenarios. How long a firm might last through a lockdown, given how much cash it had. So in other words, analysts also serve a really important modeling function that can inform the markets, even if they don't necessarily make great predictions in terms of future abnormal returns on the stocks that they cover. What about hedge fund managers? So these ones, of course, are perhaps even more likely to have abnormal performance than mutual fund managers. A hedge fund has a much more restrictive requirement on who can invest in it, this idea of accredited investors. But in exchange for that, they are much less regulated, both in terms of what they can do and how much they have to disclose. They generally won't advertise. They will generally not have too many investors. But this freedom then lets them pursue a potentially much more aggressive investment strategy. So with a mutual fund, you can't really, for example, short stocks. You can't trade derivatives. With a hedge fund, you can potentially trade alternative assets, illiquid assets. You can go short. You can trade derivatives. So does this extra freedom that is given to hedge fund managers, as well as usually the much higher incentives for performance, does that result in market-beating returns? Well, that's sort of an ongoing debate. So early on, it seemed like hedge funds had positive alphas and high Sharpe ratios, as much perhaps as per month average alpha of 17 basis points. And while that may not seem like a lot, that's 17 basis points per month, so well over almost 2% per year. And remember, that's abnormal return in excess of whatever the market makes, which is quite impressive. But after the financial crisis, that performance seems to have been curtailed. Oftentimes, hedge funds are shown not to beat the S&P 500. So then the question is this a temporary issue of a change in market efficiency? Perhaps whatever anomalies they were trying to trade have either become too crowded, as, for example, Cliff Asness of AQR has said about the value and momentum trades, or is it permanent? Maybe, as we had alluded to before, value just isn't as meaningful anymore when the book value of equity doesn't capture intangibles. That's very much up for debate, and I don't think there's a clear possible answer to it yet. But again, things like Renaissance Technologies, certain funds have definitely had very impressive returns, and indeed more persistent ones. So in a way, this is sort of a mixed bag of evidence that I think one can find whatever truth best suits them in. If you want to say that mutual fund managers outperform, there's evidence for that. If you want to say that hedge fund managers underperform, well, there's evidence for that too. Perhaps the key point is sort of what the average hedge fund manager does, and it does seem like the average hedge fund manager underperforms. But of course, everybody thinks that they are above average. The other thing is that, again, sort of going back to this idea of how do we measure abnormal performance? Well, with hedge funds, it's even more difficult. It's reasonable enough to construct these sorts of equity factors that make sense for equity long only, the market factor, maybe a value type of trade, the high minus low book to market factor from Fama French, the small firm minus low firm, small minus big firm trade, the size factor from Fama and French, the momentum trade, the momentum factor would pick that up. But when you get to some of the more esoteric hedge fund trades, like illiquid assets, some hedge funds will buy a vineyard and they will rehabilitate it and perhaps operate it for some time and sell it later, almost behaving like a private equity firm. Some will buy art. Some will buy exotic derivatives, which we don't really know what the right risk factor model is. For these, measuring abnormal performance becomes quite hard. If you have an illiquid asset, you also have this idea of, well, if it's illiquid, it's not going to be traded very frequently. So you don't really see what the day-to-day, month-to-month, or even year-to-year return is going to be like. Think about how often a vineyard will go up for sale. And so that may actually mean that if your volatility is understated, remember what your Sharpe ratio, which people often use to measure investment performance, that's sort of your return minus the risk-free rate over the volatility of your returns. But what if your volatility is really, really low just because your price hasn't changed because your asset is super liquid? Well, that means that your volatility is probably lower than it actually is. The value of the vineyard may fluctuate quite a bit. You'll just never pick it up. And that means that then the Sharpe ratio is actually going to be much higher than it is in truth, simply because you aren't picking up these price fluctuations due to illiquidity. The other problem is that you do have, from all of these exotic and illiquid strategies, you have a lot of tail risk. For example, a common strategy is being short volatility, and that often can be as simple as simply selling options. And that earns you a fairly steady stream of income until there's a big move in the markets. And then if you had a leveraged position in options, and you were short volatility, then you could get wiped out entirely. But since that happens fairly rarely, how do you, what risk factor can actually measure that? Well, there isn't really one. And furthermore, you can actually use accounting to smooth your returns even more. If, for example, well, if you can't mark to market, what you're going to do is you're going to mark to model. In other words, you'll say, yes, I know that this vineyard doesn't trade very often, but don't worry, I've got a good model of what the vineyard is worth. Well, the problem is that if you are marking to your own model, you've got incentives to make the model tell you what you like, and you probably don't want to reflect more volatility. You probably want it to reflect less volatility in valuations. So marking to internal models may also lead to too much smoothing and therefore to an overstatement of your Sharpe ratios. And then, of course, on top of that, on top of these issues in terms of measuring abnormal returns due to being unsure about what your appropriate risk factor model should be, whether your volatility of returns is actually understated, whether your returns are frequently enough observed due to illiquidity. On top of that, hedge funds will often charge a very high, something like a 2 and 20 performance fee. What does 2 and 20 mean, by the way? Well, it means that each year a hedge fund manager will charge you about 2% of your total investment, simply sort of as a management fee. And then on top of that, they will take 20% of any returns above a benchmark that your investment has earned. So that will impose a substantial performance drag on your returns as well. So then really what is the after risk, after fees performance of an investor? That makes measurement even more difficult. So for hedge funds, I think the debate is even more sort of hotly contested, and again, as it is for private equity funds. I will put some papers in the description below. So that debate very much still continues.